Welcome back to the Daily Crypto Roundup. Today's episode might end up being remembered as one of those strange moments in markets where the headlines look chaotic. But underneath the surface, something much bigger is quietly forming. Because over the last 24 hours, we've seen 5 separate stories hit the crypto world that, on their own, look unrelated. One headline talks about global stock markets melting down as the Iran conflict escalates. Another reports that nearly $500 million has just poured into Bitcoin exchange-traded funds in a single day. A third reveals that a Trump-linked mining company has massively expanded its Bitcoin mining fleet. A fourth shows the Bank of Japan expanding blockchain settlement experiments ahead of a potential digital yen decision. And finally, a major blockchain founder is predicting that artificial intelligence agents will soon become the primary users of blockchain networks. At first glance, those stories feel scattered. Geopolitics, ETFs, mining infrastructure, central bank experiments, and artificial intelligence. But when you zoom out, something very interesting appears. What we may actually be witnessing is the continued institutionalization and technological integration of crypto at exactly the moment when global macro conditions are becoming more unstable. And that combination, macro instability on one side, and accelerating crypto infrastructure on the other, is exactly the kind of environment where this industry tends to grow. So let's break down what's happening. First, we need to start with the global macro backdrop, because right now it's impossible to understand markets without looking at geopolitics. Over the past several days, tensions in the Middle East escalated dramatically after the United States and Israel conducted airstrikes on Iranian targets. The immediate reaction across global markets was exactly what you'd expect, a sharp move into risk-off positioning. Equities dropped across Asia and Europe. Energy prices surged. Oil jumped as traders began pricing in the possibility that regional conflict could disrupt supply routes or production capacity. Natural gas prices followed. When energy spikes like this, the ripple effects hit almost every part of the global economy. Transport costs rise. Manufacturing costs rise, food costs rise, inflation expectations begin to creep higher again. And that's the part central banks worry about the most. For months now, global investors have been expecting interest rate cuts in the United States, Europe, and parts of Asia. But if energy-driven inflation returns, those cuts may get delayed. That's why stock markets reacted so sharply. But crypto did something slightly different. Bitcoin initially sold off when the airstrikes were first reported. Because crypto trades 24 hours a day, 7 days a week, and it often reacts to geopolitical news before traditional markets even open. Yet once that initial shock passed, Bitcoin stabilized. In fact, while stock markets began sliding once they reopened, Bitcoin managed to hold key levels around the mid-$60,000 range. And that's exactly why analysts have started saying that Bitcoin is attempting to make a stand against broader market weakness. The idea here isn't that Bitcoin suddenly becomes immune to global macro conditions. It absolutely isn't. But there are moments where crypto markets react earlier, absorb the shock, and then stabilize while traditional markets are still repricing the news. Some analysts believe that's what we're seeing right now. Samir Kurbaj, Chief Investment Officer at Hashdex, has previously noted that crypto's 24-hour trading cycle means it often acts as the earliest barometer of global risk sentiment. When something big happens geopolitically, crypto moves immediately. Equities and commodities sometimes take hours, or even days, to fully react, and that dynamic leads directly into the second story of the day, which might be even more important for Bitcoin's price structure. Because while the headlines were dominated by war and market turmoil, institutional investors quietly returned to the Bitcoin market in a very big way. According to new data, spot Bitcoin exchange-traded funds saw roughly $458 million of inflows in a single day. That's a huge number, especially when you consider the context. Over the past several weeks, Bitcoin ETFs had actually been experiencing steady outflows. Investors had been pulling money out as prices consolidated and macro uncertainty increased. But suddenly that trend reversed. Nearly $500 million flowed back into these funds in just one session. And most of that money went into 2 funds run by the biggest players in traditional finance. BlackRock's iShares Bitcoin Trust took in more than $260 million. Fidelity's Wise Origin Bitcoin Fund attracted close to $100 million. Together, those two firms accounted for the majority of the inflows. And here's the key point many casual observers miss. When money flows into a spot Bitcoin ETF, the fund manager must actually buy Bitcoin in the open market to back those shares. That means those ETF inflows translated into roughly 7,000 Bitcoin being purchased in a single day. To put that into perspective, the entire Bitcoin mining industry currently produces around 450 new coins per day. So ETF buyers effectively purchase the equivalent of about 2 weeks of new supply in one session. That kind of supply imbalance is one of the reasons Bitcoin rallied so aggressively after spot ETFs were approved in the United States. Institutional demand suddenly became a structural force in the market. And when institutions decide to buy dips rather than panic sell during geopolitical turmoil, that sends a very strong signal about long-term confidence. Now let's move to the third story, which involves another part of the Bitcoin ecosystem that's expanding despite market volatility: mining. A company called American Bitcoin, reportedly backed by Eric Trump and Donald Trump Jr., has just purchased more than 11,000 new ASIC mining machines. For those unfamiliar with the terminology, ASICs are specialized computers designed specifically for Bitcoin mining. They perform the complex cryptographic calculations required to secure the network and validate transactions. By adding these machines, the company is increasing its mining capacity by about 12%. The additional machines will add roughly 3 exahashes per second of computing power to the company's operations. That might sound technical, but it's actually a significant increase. Bitcoin's global mining network is measured in exahashes, which represent enormous amounts of computational power. Even a few additional exahashes can meaningfully increase a company's ability to compete for block rewards. What's interesting about this expansion is the timing. Across the broader industry, many mining companies have actually been shifting some of their infrastructure toward artificial intelligence data centers. That's because AI training requires huge amounts of computing power and electricity, two resources that large mining facilities already possess. So while some miners are pivoting into AI, this company is doing the opposite. It's doubling down on Bitcoin mining. The strategy appears to be simple: accumulate Bitcoin through mining, rather than buying it on the open market. And according to company disclosures, their mining costs in previous quarters were significantly below the market price of Bitcoin. If you can produce Bitcoin at half the market price, mining effectively becomes a long-term accumulation strategy. And that reinforces another major trend in crypto. Infrastructure is expanding. Mining farms are expanding. Institutional investment vehicles are expanding. Which brings us to the fourth story: central banks. Because while crypto debates often focus on price volatility or regulatory battles, something very different is happening quietly inside the global financial system. Central banks are experimenting with blockchain technology. The Bank of Japan has now expanded a blockchain-based settlement sandbox to test how distributed ledger systems could handle financial transactions between banks. The goal isn't necessarily to launch a cryptocurrency. Instead, the experiment focuses on settlement, the process where financial transactions between institutions are finalized. Today, many large financial transactions still settle through complex clearing systems that operate in batches during specific hours. Blockchain technology could allow those settlements to happen instantly and continuously, 24 hours a day, 7 days a week. The Bank of Japan is also preparing for a potential decision on whether to launch a central bank digital currency, the digital yen. That decision is expected sometime around 2026. But even if Japan ultimately decides not to issue a retail digital currency for the public, these experiments show something important. Central banks increasingly believe blockchain technology can improve financial infrastructure. And this isn't happening in isolation. Similar experiments are underway in Europe, the United Kingdom, Hong Kong, and Singapore. Governments are exploring tokenized bonds. Banks are experimenting with on-chain settlement systems. Cross-border payment projects are testing blockchain rails. In other words, the financial system is gradually integrating the technology that originally powered Bitcoin. And finally, The fifth story connects crypto to another technological revolution that's unfolding at the same time: artificial intelligence. Ilya Polosukhin, the co-founder of the Near blockchain, recently suggested that AI agents may soon become the primary users of blockchain networks. The idea might sound futuristic, but the logic is actually straightforward. AI systems are becoming increasingly autonomous. Instead of just answering questions or generating text, AI agents are beginning to perform tasks independently. But there's a problem. If an AI agent needs to pay for something, data, computing power, or services, it can't open a bank account. It can't pass traditional identity verification checks. Blockchain systems solve that problem, because on a blockchain, any entity can control a wallet and send transactions. That means AI agents could theoretically operate economic systems of their own, earning revenue, spending funds, and interacting with smart contracts. Some researchers call this the machine economy, a world where billions of autonomous software agents transact with each other using blockchain networks. Now, that future may still be years away, but the idea highlights how crypto infrastructure might eventually support entirely new types of economic activity. And when you connect all of these stories together, the pattern becomes clearer. Global markets are becoming more volatile. Geopolitical tensions are rising. Energy prices are surging. Yet at the same time, the infrastructure supporting crypto continues expanding. Institutions are allocating capital through ETFs. Mining companies are increasing network power. Central banks are experimenting with blockchain settlement. Developers are exploring how artificial intelligence could interact with decentralized networks. Those forces don't necessarily guarantee higher prices tomorrow or next week. But historically, the periods when infrastructure quietly expands during macro uncertainty are the moments that lay the foundation for the next phase of growth. Because once the infrastructure is built, capital and innovation tend to follow. So the real question investors should probably be asking right now isn't just where Bitcoin trades next month. It's whether the structural integration of crypto into global finance and emerging technologies is continuing. And based on the stories we're seeing today, the answer appears to be yes. If you found today's breakdown useful, make sure you're following the show so you don't miss the next episode. Drop your thoughts in the comments, smash like, follow the podcast, and we will see you at the top.